Okay, so we start this new standard. This is IS 23, borrowing cost. Actually, if you notice that the slides which we have uploaded, you would see in chapter number 3. And in books also, because there are few chapters, few standards which are together in one chapter. Like if you remember that in UF7, the chapter number 3 is tangible non-current assets. So that IS 40, investment property, borrowing cost, IS 23 and IS 16, they all are together in one chapter because they are quite related. So borrowing cost is a short standard, but it's practically quite applicable, and it comes a lot in questions. Because in F7, you do not expect a question coming only straight from F7. Usually there is something mixed up with different standards, and this borrowing cost is one of those. And I think we talked about it before as well, but now I just want to finish it formally. The concept is that usually when you take a bank loan, and of course you have to pay interest, and the interest which you pay, it is called your operational expense. It is your operating expense, and it goes to the income statement as finance cost. So you have taken different types of loans on different type of condition. You may have issued bonds. You probably could have taken a bank loan. You might have taken a short-term period like overdraft, or maybe a longer-term loan, or you are paying interest on leasing. So all different types of interests which you will pay. And sometime if you make payment late to a supplier, like in IFRS 15, we said that significant financing component. So you purchase something on credit, supplier says that you paid now, it is 10,000. You pay after 1 year, it is 11,000. So 1,000 which you pay extra for making a late payment, it is actually a finance cost. So you pay interest expenses in different formats, and all of those forms, they go to the income statement as interest expense, as finance cost, except for the concept of borrowing cost. Borrowing cost, the concept is like if you are preparing an asset. So we are talking about the standard says you that usually it is given for self-constructed assets. Self-constructed assets means that, let's suppose you are making a building, and to make this building, definitely it is going to take some significant period of time. Probably you will take like a year, or probably 2 years or 8 months. IFRS does not talk about time, but it says that you are doing a construction, or you are constructing an asset, and you took some loan, and you took, say, I don't know, $5 million loan. You took $5 million in loan for the construction of this building. So you definitely are going to pay interest on this loan. Let's suppose you are paying, I don't know, 8%. So this 8% interest, which you would pay on this 5 million, you can capitalize this interest. Okay. So the word is capitalize. Capitalizing means considering it as a capital expenditure and adding it on the top of to the construction project. So you will make $5 million you will spend on this building, plus you will make some, you will pay also interest. So this interest must be added to the 5 million. Okay. So it means that is what you call capitalization. So there is some capitalization of interest. So you do not, so this interest, you do not take it to the income statement. You don't call it as interest expense. You consider it as your tangible non-current asset, or intangible, whatever. And you, when you pay interest, you would say debit non-current asset, and you say credit, whatever, bank or cash, whatever, credit, bank or cash. So this is the concept. Like usually when you pay interest, you write down here interest expense, you say debit interest expense. Okay. When you call it debit interest expense, $10, it goes to the income statement as interest expense. Here you will not call it interest expense. Here you will call it debit non-current asset. So when you say debit non-current asset, this interest, whatever $10 you have paid, it is added to the cost of the asset. So this is the concept of borrowing cost. So in borrowing cost, we understand that it allows us, IFRS allows us to capitalize our interest. But of course, there are certain conditions. there are certain conditions. First condition is, which comes to your mind, that which type of assets I can do it. If you purchase something like you purchase a car or you purchase a house on like some kind of credit, like a mortgage, you know, people, they buy houses on mortgage, and then they pay interest for the next 20 years. Can you capitalize it? The answer is no, you will not capitalize it. That interest is not capitalized. You capitalized it for probably mostly on the construction of these assets. Okay. Do you also, you pay interest when you purchase a car? Do you capitalize that interest when you purchase a car? No, you do not. So first type is that which type of assets you capitalize. You call it a qualifying asset. And we will discuss what is qualifying asset. The second thing is that how much interest I can capitalize. So the answer is that you can only capitalize interest for the construction period. Like you have taken loan for 5 years. So there is a 5-year period. And within first 1 year or probably within first 6 months, you will make the building. And then you start using the building. So you took loan here in this period, only this period where the construction begins and where the construction ends. This is the time period where you can capitalize. Probably you took loan here. For the first few months, you were not using, the construction did not begin. So this will go to the income statement as interest expense. This will not go to the balance sheet, okay? Then you finish the construction and you start using the building. So this part is also, you will pay interest because your loan total duration is 5 years. The loan has been taken for 5 years, but you cannot capitalize for all 5 years. This 1 year, when you were doing the construction, this only will go to the balance sheet. This will be considered as the capitalization period. This remaining period, you cannot capitalize. It will go to the income statement as operating expense. And there's a very strict criteria, and I will explain that. So the concept is that what or how much interest you can capitalize. Answer is you can only capitalize interest during the construction phase. And now there are some little technical details. We will discuss them. So now let me remove this thing and we start doing the chapter. I have already given you the understanding. It says borrowing cost, interest and other costs incurred by an entity. So it's not only interest, but there are some other costs like the cost which you incur during the process of acquisition of loan. You paid some kind of bank fee or whatever, incurred by an entity in connection with the borrowing of funds. Qualifying asset, an asset that necessarily takes a substantial period of time to get ready for its intended use or sale. So substantial period. IFRS does not define what is substantial. Usually we consider that it should be more than 6 months. So if you purchase a house, it is not taking a substantial period of time for completion. Okay, today you make a deal, tomorrow you move in. You don't, so the apartment which you purchase on credit, like, you know, it is very common. People, they pay 10-20% advance and 80% they take mortgage from the bank. That is not a qualifying asset. So you need to understand the qualifying asset. In your F7, at your F7 level, they do not expect you to take that decision of qualifying or not, because in F7 questions, usually they will tell you that this is a qualifying asset or not. So it's not trouble for F7 level. Accounting treatment, borrowing costs that directly relate to the acquisition, construction, or production of a qualifying asset must be capitalized as part of the cost of that asset. This is what we just discussed. Types of borrowing cost: funds borrowed specifically, funds borrowed generally. Funds borrowed specifically means that probably you took some loan and you took it at 8%. So this 8% is your borrowing cost. This is called specifically. Borrowed generally. Borrowed generally, what does that mean? Probably you have in your portfolio, you have different types of already acquired funds. In your portfolio, you have different types of debts, okay? Something you took on, I don't know, probably you took something on 7%. Maybe you have taken some loan on 10%. And then probably you have taken some loan on 8%. So you have different types of borrowings, okay? And we talk, and then out of this portfolio, out of this entire portfolio, this is your portfolio, and it consists of, I don't know, this is your debt portfolio, okay? And your total debt is, together it is 50 million. And out of this 50 million, you take out some funds. You take out some funds for the construction project. You took just 5 million for construction project. So you took 5 million from your portfolio of funds. Now the question is that how much should be the interest? Now that is called funds borrowed generally. So here what you should do, you should consider an average cost. Okay. So out of this 50 million, how much was 7%? How much is 50 million? How much is, and let me tell you that if you have to do it very quickly, you've got, 10 million here. This is a simple concept I want to explain you so that it may use somewhere later as well. Not only you will use it here, but you can use this somewhere as well here. For example, you've got here 10 million, 15 million, and then you've got 25 million here, okay? So what is your average debt cost? Your average debt cost should be something like this, 10 divided by 50 multiplied by 7%. I'm taking the proportion, plus 15 divided by 50 multiplied by 10%, plus 25 divided by 50 multiplied by 8%. So this is, we took the weighted average. We are taking the average. That you say that, out of 50 million, 10 million is at 7%. Out of 50 million, 15 million is at 10%. And out of 50 million, 25 million is at 8%. When you make an average, you may get something like 8%, 8.2%, 8.3%. Then that average cost you should use. So either you have a specific rate or you have an average rate. So funds borrowed specifically and funds borrowed generally. Generally, capitalized borrowing costs calculated as the weighted average cost of borrowing for the period, multiplied by the expenditure on the qualifying assets. Note that the amount capitalized should not exceed total borrowing costs incurred in the period. So this is the average way we have calculated. So this is two types of fund. Now that's very important, commencement of capitalization. When your capitalization should start. Maybe you have taken the funds here at this point, okay? But you start the construction here in this period. So these 2-3 months, the funds remain with you and you could not start the construction. Why? Because probably your construction workers are not available. Maybe you have not taken the required permissions. Maybe your design work is not ready. Maybe your raw materials or equipment or machinery is not there. So in this period, you must be paying interest because the bank, you have taken the money, but this interest will go to the income statement because IFRS says that why should you capitalize the interest, Directors, by the way, always remember, directors or the management, it suits them to make it capitalize in the balance sheet. This is a general approach. The management always want to maximize capitalization. Please understand it very clearly so that you understand the IFRS logic. Directors or management usually do not want to show expenses in income statement because when you write down some expense in your income statement, your profits, they go down, okay? Your profits, they go down. Profits will decrease when you write down expense in income statement. And management never wants profits to go down, because when profit go down, the market share price in the market, it is affected. Directors bonuses are affected. Future investors you cannot attract. Directors, their contracts and their bonuses, everything. So directors usually try that profits should be more. They want to show more profit. If you think about these large corporations, Samsung and Apple and Microsoft or whatever, they do not even wait for the end of the year. Every first quarter, they say, first quarter results announced, $3 billion profit. Second quarter results announced, $5 billion profit. So they are actually uh, claiming their profits even after 3 months. And they are making large announcements. They are making loud announcements. So if you ask me, that usually the management, their perspective is that they don't want to write down an income statement. What they try to do, they try to throw things from income statement to balance sheet. Because if I write down here $100 as an expense, my profit will decrease. So what they do, they take this 100 and they try to put it into the balance sheet. When they put $100 in the balance sheet, their assets would go up, and here their profits will go up. So the more you can capitalize, the more attractive picture you are showing, because the maximum expense which you are taking from income statement and somehow capitalizing it in the balance sheet, your profits will increase and balance sheet assets will increase. So this is a general uh, tendency in the management. IFRS will try to stop this behavior. IFRS does not allow managers to take things from income statement and throw them into the balance sheet. IFRS will put all the possible barriers on this behavior. So we as managers, we took $5 million on January 1st. On January 1st, we are taking loan on 1st of January, here in how to say on 0101. Let me write down here 0101. And the construction is starting on 0103, which means 1st of March. IFRS will say that you cannot capitalize this because construction did not start. Me as manager, I would say that, see, I have taken the loan and I have paid interest. And if I have paid interest, kindly allow me to capitalize. And IFRS will say that, why did you take loan in January? When you knew that the construction would begin in March, why did you take loan 2 months before? You took loan 2 months before, or maybe you could not bring the documents here. Now let this interest go into the income statement. Let your profits go down and you become answerable to the shareholders. Now, this is done so that me as manager, I become very careful in taking the loan and the timing of loan so that extra interest is not paid. So one thing, what you remember, that you call it commencement of the interest, okay? So commencement means that when the construction period will start. Now, this is our construction phase. Commencement of capitalization, expenditures. So your commencement begins when expenditure for the asset are being incurred, borrowing costs are being incurred, activities that are necessary to prepare the asset for its intended use or sale are in progress. So when construction is going on. It is also possible that for a certain short period, the construction stops for some reason. If there is any stoppage in construction period, this period we did not do construction. For 2 months or 3 months, we stopped for some reason. Again, this interest which you will pay in this period, here if you pay any interest, it will also go to the income statement, always remember. Okay, so I was doing construction, this interest I will take into the balance sheet. That's I'm allowed to capitalize. But here I stopped construction for some period, for some particular reason. Construction activity was not going on. So if you pay any interest in this period, it will also go to income statement. And then when you start construction, then you start capitalization again. You see, IFRS tries to stop you. And here the construction finishes and your interest capitalization will also finish. In this period, interest will go to the income statement. Okay, let me now delete all of this. And you call it suspension and cessation. Suspension is that, like I explained to you before, a temporary halt in the construction phase. Capitalization of borrowing cost should be suspended during extended periods when development is interrupted. If you are not doing any construction for that 1 month or 2 months, you cannot capitalize. And then you call it, okay, I'm sorry, this is called suspension. Suspension means the temporary stoppage. And cessation means you permanently stop. Capitalization of borrowing cost should cease. Cease means when you stop permanently. Suspension is temporary. Cessation is when you are finished. When substantially, now, when should you cease? When should you stop? You see, you say that this is my building, this is the construction period has finished. So this is called cessation. And when this cessation happens, it says capitalization of borrowing cost should cease when substantially all of the activities necessary to prepare qualifying assets are complete. Substantial. It does not say when the asset is fully complete. Now here you should pay attention. Listen. You know, you have to understand what will happen here. Me as a manager, I would like, or I would prefer to capitalize for as long as possible so that I take it to the balance sheet. So you know what I do? I make the building and then I put the doors and I don't put the handles and I don't put the electricity fittings, or probably I do not uh, polish the floors. And I say construction is still going on, the building is not finished. So let me capitalize. IFRS will not allow, because IFRS says when it is substantially finished, like when you have finished the structure, structural work is done, the building is substantially complete, so you should consider it as complete and stop the capitalization of interest. These little or minor things you will continue to do, no problem, but your capitalization should stop. So IFRS does not say that when the building is completely free. There is no concept of completely free. Concept is when it is substantially complete. So this is a very short chapter, borrowing cost. You usually get questions from calculating the initial value of an asset. You add borrowing cost into that, you add provision into that. So you don't get a separate question for that, but it is mixed within the tangible non-current asset question.